Well, good afternoon, traders. Chris Weston here, Head of Research at Pepperstone. Well, it's the end of the week. I hope everyone's had a successful week in the markets. And we're going to use this video again just to explore what's happened, the kind of the major thematics that we've taken out here, what's caused those, the sort of performance of various asset classes. And then we're going to spend most of the time looking ahead at next week, ultimately the stage that's been set both from implied volatility, realised volatility, interest rate expectations and position and sentiment. I like to use skew as my weapon there as well. And I use this as part of my trading, my sort of trading process, where we're looking really for me as a macro discretionary trader, looking at what's causing the move from A to B, the probability of that likely to go, and then looking at the variables that define things like your risk assessment, your appetite for position sizing, and those various factors as well. So this is something that's very close to my heart in terms of the trading process that we're going forward. But let's go straight to the boards and have a look at how the performance of G10FX markets has gone, and you can see straight away that the Swiss franc has done pretty well, up 1% against the US dollar. It's the best performing currency at this stage. Now, I will say that I'm recording this before Friday night's trading session in Europe and the US, and these numbers may differ a little bit, but at this snapshot in time throughout this week, the Swiss franc has been the best performer. Now, there has been some, I wouldn't say risk aversion in markets. There's been a really good move up and a strong move up in risk assets for quite some time, based on the idea that the global data was improving and showing green shoots, or certainly less bad. We've seen convergence between the US and China. People have got very excited about a phase one trade deal. And of course, the Fed's liquidity injections through the repo operations had seen the Fed's balance sheet increase by something like $280 billion. And people were seeing that as a QE light, a mini QE, for example. That better liquidity boosting risk assets, cyclicals outperforming defensive, value outperforming growth, for example. They've all done pretty well. Now, we have run into a period of exhaustion, and sort of markets have rolled over a little bit. I think some of the headlines out of and some of the ugly scenes we've seen outside of Hong Kong or inside Hong Kong have been one reason. The Hang Seng down 5.5%. We've seen 12-month HIBOR rates and forward rates in Hong Kong really moving up quite sharply. So funding costs and the idea of liquidity obviously being a concern there, and we've seen that spill over into the mainland Chinese markets, which have done very well. And so just the idea of exhaustion coming through there, the elastic band being pulled back a little bit too far, and it doesn't take a lot really to move that. But the CSI 300 down nearly 3%, and that's caused some angst in coming through in Europe as well, and that market down a touch. But the data, I think all those combinations of factors very much still in play, and we're watching that. But certainly a bit of a bid coming back in the bond market. We've got 10s down about 12 basis points in the US. I've seen a bit of a bid coming back into the German bond market, but there has been such an extreme sell-off of late, such a steepening of the curve, those duration positions unwound, that it hasn't taken much just to see come back in. That's why this week coming forward will be a defining week. But certainly the Swiss franc doing quite well. We've also seen the Kiwi dollar up about 85 basis points. Yeah, that was the big surprise of the week. The market had gone into this expecting another rate cut most people were expecting a rate cut from the Reserve Bank of New Zealand. That obviously hasn't happened. And I think what we've been left with is clearly a sign now that all of the G10 central banks are in this kind of wait and see hiatus. They're waiting for new data. They're looking at inflation expectations. They're trying to see whether there's going to be a material shift from this, but they're much more of a reaction from monetary policy. And the bar now to cutting from a lot of these central banks is sufficiently high enough that the market now has repriced themselves. If you can go down to the chart, which you can see here, having a look at interest rate expectations, you can see in the third from right column just where we are at the moment. Take away the Reserve Bank of New Zealand, where we're expecting at the next meeting 40% chance that they cut. But let's not forget that next meeting takes place in February, so they've got a number of months to get new data and new flows to see how that happens. There's a lot of information that needs to happen around what's happening in the trade situation. There was an article in the Financial Times which have caused a bit of angst, suggesting that it's going to become somewhat more complicated for this phase one deal to be complete. And again, the idea that Donald Trump saying there's going to be a deal signed, are we going to see a rollback of tariffs? It seems pretty unlikely at this stage, and that's what China wants to see a phase one. So there's a lot of water to still pass under that bridge. I think that's why you've got that Reserve Bank of New Zealand pricing at around 40%. But elsewhere, you've got nothing priced in Europe. You've got very little priced in Japan. You've got very little priced in the UK and Canada and Australia. And you look out to the rates curve, go to the swaps curve over 12 months, and you can see, we've got to a stage where, you're either pricing in, very little amount or getting to probably one rate cut over 12 months. And that's where we are. So we're in a much more neutral setting on rates. The market's saying on balance, we probably expect further easing, but that barrier has certainly come up quite sharply. On the downside in G10, we're back to this chart. You can see that the Aussie dollar is down 1% for the week. Obviously, that's a reflection that we saw that jobs number. It was pretty poor, to be honest. There wasn't really much you could take out of the jobs number we saw that could really inspire. The participation rate was down. We saw the unemployment rate up. The number of jobs was one of the worst in a long time. The RBA would be looking at that and saying, if this starts a trend, this idea of quantitative easing, which a number of investment banks such as JP Morgan have float for next year, is definitely one that you need to keep an eye on. So the Aussie dollar down 1%. I think that's also a reflection that the CNH has weakened off a little bit. So the idea that we've seen a slight moving apart of Trump and Xi, I suppose, after people are sort of having to second thoughts whether we're going to have a phase one deal, has seen dollar CNH moving up again, and I think that that weakness we've been seeing in the CNH, the offshore Chinese yuan, has weighed on the Australian dollar, not just the jobs number there as well. Now, if you go into EM, EM, emerging markets, had been the darling of markets. People have been saying we've got to go overweight, the dollar's going to weaken. We've seen better liquidity home through markets. Well, the emerging market trade's starting to unwound. I know we've had issues in Chile. And you can see the peso there down nearly 7%, but that's a sort of idiosyncratic issue. Most of emerging markets has been falling as well. The Mexican peso, probably your number one pick in terms of a proxy of EM in the FX market there, down 1.1%. The Colombian peso down 3.3%. But it's really hard to find too much love. Okay, Turkish lira up 0.3%, but I think that's because we've been seeing such low volatility playing through in markets that people have gone into carry in that trade there as well. So certainly in the EM, we've seen that struggle. And if we do see the EM, the ETF there coming under pressure, further pressure, a large of that down to what we've been seeing in some of the Chinese markets, then I think global equity markets more broadly may struggle going forward. If you have a look at what's really driving FX markets for me, have a look at the chart you can see here, which defines dollar CNH, which you can see as the white bar chart. Now that's in the right way. And what I've done is I've overlapped the 10-year US Treasury. Everyone's been talking about what's happening in bond markets, the idea that bond markets have steepened, the curves have steepened, and they've sold off towards the back end because we've been seeing better data. Well, that is technically true. But what I think what's really interesting, what's been the clear driver of variance within the bond market and also things like dollar yen and rates and various factors, is what's happening in dollar CNH. Now, if we think that dollar CNH, the offshore yuan, has been a clear proxy for trade, then you can see that we had this really nice sell-off going through sort of October into November in dollar CNH. People were seeing convergence. People were talking about phase one. We got down to sort of 6.95 in dollar CNH, and now we've started to see a sell-off as people are starting to question whether we're going to see that phase one. As you can see, during that sell-off we saw the US 10-year Treasury rally. Now I've inverted this, so when you're actually seeing it through October going down, it means that yields have been going up. What we've been seeing since this bid that we've seen in dollar CNH and the CNH selling off is yield starting to fall again. So what for me has been the clear driver of variance in the 10-year Treasury yield, and we can extrapolate that across other asset classes, has been this dollar CNH move, which has been a proxy of trade. So trade has been and continues to be the dominant thematic playing through markets. Now, if we have a look at event risk as we go through the new week, there's really not much to focus on. In Australia, there's very little. We've got the minutes playing through. I don't expect them to be an event risk. In the US, you've got leading indicators. You've got the housing starts and some existing home sales. And again, they're not really going to be too much of a driver. I think we've got the Fed minutes as well to focus on. But again, they're not going to be a volatility driver. In terms of Fed speakers, we've got Mester, Kashkari, and we've also got John Williams. But again, we've heard from people like Richard Clarida, we've heard from Jerome Powell a couple of times, and the markets seem pretty comfortable with the view that they've got. In Europe, you've got PMI numbers playing through. Again, they could see a bit of improvement, and that could be a small positive for the euro. In UK, there's not really much to focus on. We'll be continuing to focus on the polls and whether or not this dominant lead continues to play through for the Tory party after Nigel Farage seems to have fallen on his sword and allowed 317 uncontested seats. That's still something that we'll be watching very closely. And I think it's really interesting if you have a look at implied volatility over the Brexit timeline and have a look at cable 1 month implied volatility, it stands around 12%. That's a 380 pip move if we're looking at the straddle pricing. It's not fireworks. The market at this stage is saying we probably believe on balance that we're going to get a Tory majority, and there's probably a good chance that they may get a strong majority of over 20 seats. They could be wrong, of course, but that would have have big implications for the pound when we go through to the next stage, which would be the transition period, and the clear need, in my opinion, from about halfway through next year to extend that transition period. There is no way, in my mind, that they're going to form the right sort of trade deals with the Europeans within that 12-month period. It's too small, too short, and they're going to need an extension probably for another 2 years, in my opinion. Having a strong majority in the Parliament, in the Commons, would be a strong sterling positive in that regard there as well. So that's something we are watching. But in terms of the data flow, China, there's very little to focus on. New Zealand and Canada, not really watching too much there as well. So again, if you have a look at that dollar CNH chart, if you see what's going on there, the dominant driver of markets continues to be dollars to what's happening in the trade tensions, and we'll be watching headlines playing through there as well. I want to touch on volatility, because implied volatility, as I said earlier, is absolutely shot to pieces. Go to the equity market straight away before we go to the vol chart. Have a look at the chart, which we can see historical 10-day S&P volatility overlapping implied volatility. I've got the 30-day implied volatility of the S&P there. Slightly different from the VIX, but the VIX uses a weighted average of various different strikes. We're just going to look at the 30-day implied volatility here, the 100% moneyness. And you can see that the historical 10-day volatility in the S&P is trading pretty much the lowest level since October. There is very little life. The ranges in the S&P are very low at the moment. Can that change? We're obviously yet to be seen, but implied volatility needs to catch up there a little bit going forward as well. But historical volatility, where we've been, is certainly very low at the moment, and I don't think that's necessarily going to surprise too many people. And that takes us, to what we're looking forward. I can aggregate everything that I've been seeing in what we've been seeing in that data flow that I talked about there, and you can see that the ranges are very, very low in terms of their expected. Focus on that middle column, which you can see is that kind of nice peachy colour implied volatility rank. Now that looks at the 1 week at the money implied volatility in these FX markets, and you can see things like Aussie yen 8.2% annualized. We take that down into a weekly vol, and that's the 20th percentile. So forget it if you're not well versed in implied volatility over the week. What we need to know is that number there is in the 20th percentile of the 12-month range, so it's very low. The market's not expecting big moves. We can actually then quantify that, putting that price into the Black-Scholes formula and looking at what the straddle price is, and they're saying that that's worth 76 points effectively. That's what the theoretical price of the option is, with a degree of confidence there, 68.2% level of confidence. So that's a 76-point move. So the market's saying on the week we expect probably with a 68.2% level of confidence that the Aussie yen shouldn't really go much higher than 74.33 and down to 72.81. We go into things like euro sterling, which has been working quite nicely in terms of the downside. It's sort of consolidating in that sideways channel. Euro sterling 15 percentile. 6.26 annualized volatility, standard 1 week vol there. That's a 67-point move. Euro dollar, look at the implied volatility in that 3.82%. That's the second percentile. In the 12-month range, we've very, very rarely seen it this low. So the market is expecting a 50-point move in euro dollar. That's 110.72 down to 19.72. The market there very much lacking a pulse. If euro dollar is lacking any kind of pulse, of course G10 FX vols, if you aggregate them, are very low as well. So the market this week is not expecting any kind of big moves. I think that's a reflection that we've been very low, and the data this week unlikely to change things too much. That has big implications for your position sizing. In that situation, you can afford therefore to have a somewhat tighter stop. Therefore, you can have a bigger position. You go into the vol structures down at the bottom there. You can see VIX. Just over 13%, that's the 8th percentile. You go into Treasury volatility, 29th percentile, of all volatility, 17th percentile. So we are in a stage now where implied volatility is very low. Yeah, we've seen risk assets moving a little bit lower of late, but yeah, implied volatility is very low. So do keep an eye on this chart. People will look at the realized volatility when you're using this for your technical structures. Have a look at implied vol at the moment. Can this change? At the moment, the market is just not expecting any kind of fireworks. Then we can go into the last chart where we can actually look at the skew between call volatility, 25 delta, down to put volatility, And then on the right-hand side, we've got the commitment of traders report. Again, we've had a bit of a position flush out. Gold's really interesting as well because that's been very nicely correlated to what we've been seeing in the falling pool of negative yielding debt. If that pool of negative yielding debt increases, then gold prices are going to go higher. Have a look at those risk reversals though. They've come right back down to sort of a much more equilibrium situation. At one stage a few weeks ago, we saw this really strong propensity to hold call volatility over put volatility. Traders were betting that we were going to get a much more aggressive upside move in gold. That positioning has come right out of the market. Sentiment's much more neutral. It's a much better, cleaner position if you are bullish on gold to be getting in at these levels now. That would be a reflection that we are going to see higher volatility. Markets are going to tumble a little bit, but that skew of put to call volatility there, I think has come to a much more neutral setting, and that's something that's very much on my radar there. So for me, as we go through the new week, we're watching continue those headlines. We're continuing to look at what's happening in implied volatility because at the moment markets are very, very sanguine. Good luck to you all.